Something happened today that Wall Street has never seen before. At 6 a.m. Eastern this morning, before American markets even opened, oil blasted through $100 per barrel, then $110, then it kept going. Brent crude spiked to $119.50. West Texas Intermediate hit $119.48. Oil hadn't been above $100 since Russia invaded Ukraine in 2022. And then Donald Trump picked up the phone. He called CBS News and said the war with Iran was very complete, pretty much. He said he was thinking about taking over the Strait of Hormuz. He posted on Truth Social that Iran would be hit 20 times harder if it tried to stop oil flows. He told reporters the war would be over very soon. Within hours, oil collapsed. Brent fell from $119 to $88. WTI crashed from $119 to $85. A $34 swing in a single session. More than 10% wiped off the price of the most important commodity on earth because of words spoken by one man into a telephone. But here's what nobody on television is telling you right now. The G7 finance ministers held an emergency virtual meeting today and issued a joint statement saying they stand ready to take necessary measures, including to support global supply of energy, such as stockpile release. G7 energy ministers will hold another meeting tomorrow morning to discuss a coordinated release of emergency oil reserves from their strategic stockpiles. Multiple governments simultaneously coordinating emergency energy actions. That is not the behavior of governments who believe a phone call ended the crisis. That is the behavior of governments preparing for the crisis to get worse. Right now, millions of middle-class Americans are looking at that crash in oil prices and feeling relief. They think the crisis is over. They think gas prices will come back down. They think the worst is past. They're wrong. And that relief is exactly why this is a trap. Because here's what Trump's own defense secretary said just hours after that phone call. Pete Hegseth held a Pentagon briefing and stated that the war with Iran would not end until the enemy is totally and decisively defeated. On America's timeline, not Iran's. 2 messages. Same administration, same day. The president says it's almost over. The defense secretary says it continues until total defeat. Iran's new supreme leader, son of the leader killed in the initial strikes, just took power, with Vladimir Putin immediately pledging unwavering support. Iran's IRGC spokesman said this weekend that Iran is prepared to continue waging an intense war for at least 6 months. Iran's foreign ministry warned today that oil tankers must be very careful, and that as long as the situation is insecure, all maritime navigation faces risk. Saudi Aramco's CEO Amin Nasser, the man running the world's largest oil company, said today that this one by far is the biggest crisis the region's oil and gas industry has faced, warning of catastrophic consequences if oil flows don't resume through the Strait of Hormuz. This is not a crisis that ended today because of a phone call. Markets briefly repriced because one man said reassuring words. And the last time that happened, during an active military conflict, the repricing was wrong. Wrong in 2003 when the Iraq invasion was supposed to be quick. Wrong in 2001 when Afghanistan was supposed to be contained. Wrong every single time a president said, this will be over soon during an active shooting war. But here's the part that matters most for your family. The trap that nobody on television is explaining. Even if oil drops back to $70 or $80 tomorrow, the damage to the middle class has already been done, and it's about to get dramatically worse. Because the oil price isn't the trap. The trap is everything the oil price has already set in motion. And none of that can be reversed by a presidential phone call. When oil spikes to $120, even briefly, it triggers a chain reaction through the entire economy that takes months to unwind. Not days, not weeks, months. The diesel that trucks burn to deliver your groceries was purchased at the higher price. The jet fuel airlines locked in for the next 30 days was contracted during the spike. The shipping insurance repriced for the Strait of Hormuz stays, repriced until underwriters feel safe again, which could take months. The cargo ships that rerouted around the Cape of Good Hope are already on their 10 to 14-day detour and cannot teleport back. The production that Kuwait, Iraq, and the UAE already cut doesn't restart with a light switch. It takes weeks to bring wells and refineries back to full capacity. This is what economists call the asymmetry of oil shocks. Prices go up like a rocket and come down like a feather. The gas station raises prices the same day crude spikes. It takes 2 to 4 weeks for a crude decline to reach the pump. And the secondary effects, grocery prices, shipping costs, airline tickets, utility bills, take even longer to normalize. Some of them never fully come back. Here's the concrete proof from the last oil shock. When Russia invaded Ukraine in February 2022, oil spiked above $120 per barrel. Gas hit $5 per gallon nationally. Oil returned to pre-war levels by December 2022. Gas prices did not. The national average at the end of 2022 was still $3 per gallon, well above the $2 range before the invasion. Food inflation and shipping surcharges persisted through 2023. Some grocery categories never returned to pre-spike prices. The damage was permanent, and this shock is structurally worse. In 2022, the Strait of Hormuz remained open. Russian oil was reduced but not eliminated. Alternative supply existed. This time the strait is physically blocked. Gulf producers are cutting production because they literally ran out of storage space. Kuwait invoked force majeure for the first time in decades. Iraq slashed 1.5 million barrels per day. Ships are not moving. Insurance companies have withdrawn coverage. And the Houthis have resumed attacks in the Red Sea, disrupting the alternative Suez Canal route simultaneously. Rapidan Energy Group, one of the most respected oil consultancies in the world, published an analysis stating this is the biggest supply disruption in the history of oil. Not the biggest in recent memory, the biggest in history. And a phone call didn't fix it. The consumer damage is already happening in real time. Gas prices surged past $3.15 per gallon as of Sunday morning, a 10% increase in a single week. That was before oil hit $120 this morning. By the time today's spike flows through to the pump, analysts are projecting gas could approach $3.50 to $4 nationally. Gas Buddy's Patrick DeHaan had already warned that gas stations could raise prices 30 cents per gallon within a week of the crisis starting. We are now in week 2, and today's spike adds another layer of cost that will take weeks to unwind even if crude drops. Real retail sales already dropped 0.7% in the most recent report, worse than economists predicted. The 25-cent spike that hit in early March acted as what analysts called an overnight tax on disposable income. Consumers immediately cut spending on apparel, electronics, and home furnishings. Even online retail contracted, and that was at $90 oil. At $120, even briefly, the psychological damage is devastating. Consumers don't remember the price dropping from $120 to $88. They remember the price hitting $120. They cancel the vacation. They delay the car purchase. They downgrade the restaurant to fast food. They look at their budget with the kind of anxiety that comes from seeing a number that starts with 1 on the barrel. The University of Michigan Consumer Sentiment Index had already stalled at 56.6 in February, roughly 20% below where it was 14 months ago, and that was before today's spike. When the next survey captures this week's price action, expect another significant decline. A 10% crash in oil takes minutes. A recovery in consumer confidence takes months. The New York Federal Reserve released its February survey of consumer expectations yesterday. One-year inflation expectations spiked from 3.1% in January to 4.2% in February, the largest month-over-month increase since the post-pandemic supply chain crisis. 3-year expectations rose to 3.5%, meaning consumers no longer view this as temporary. They see it as structural. And this is where the trap closes. Inflation expectations are self-fulfilling. When consumers expect 4% inflation, they demand higher wages. When businesses face higher wage demands on top of higher energy costs, higher shipping costs, and higher tariffs, they raise prices. When prices go up, consumers see their expectations confirmed and demand even higher wages. This is the wage price spiral, the exact scenario the Federal Reserve has spent 4 years trying to prevent. A single week of oil prices above $90 just reignited it. The Fed cannot cut rates to help the middle class. They were already stuck before the war. Core PPI came in at 0.8% in January, nearly triple expectations. Annual core wholesale inflation hit 3.6%. Consumer inflation was at 2.4% and heading in the wrong direction. Tariffs were already at 16.9%, the highest since 1932. Now add an oil shock that pushed crude above $100 and inflation expectations to 4.2%. JP Morgan's Ellen Zentner wrote that significant labor market weakness would normally support a rate cut. But given the risk that sustained elevated oil prices could trigger another inflation surge, the Fed may feel compelled to remain on the sidelines. Translation, even though the economy lost 92,000 jobs in February, even though the Atlanta Fed slashed GDP growth from 3% to 2.1% in a single week, even though retail spending is contracting, the Fed cannot cut rates. Because inflation is too hot. This is stagflation, growth falling, prices rising, the central bank frozen, the middle class caught in the crossfire. Let me put this in dollar terms for an average American household. Before the war, the EIA projected Brent crude would average $58 per barrel for 2026. Gas was heading toward $2.70 to $2.80 nationally. A typical household driving 2 vehicles was on track to spend roughly $3,000 on gas for the year. Now, with oil averaging $80 to $100 for the next quarter, that same household's annual gas bill jumps to $4,200 to $4,800. That's $1,200 to $1,800 per year in additional fuel costs alone. But fuel is only the beginning. Food prices were already 2.9% higher year over year in January, with non-alcoholic beverages up 4.5%. When diesel hits $4.16 per gallon, every link in the food supply chain gets more expensive. The trucker hauling lettuce, the refrigerated warehouse, the last mile delivery van bringing groceries to your door. Capital Economics estimates sustained $100 oil adds 0.6 to 0.7 percentage points to global inflation. The Dallas Fed models it higher at 1.3 percentage points for U.S. headline inflation. For a family earning $60,000 per year, even a half-point increase in inflation erodes $300 of purchasing power. A full point erodes $600. Combined with the additional gas costs, the total annual hit to a middle-class household is $2,000 to $2,400 per year. That's not a rounding error. That's the family vacation. That's the emergency fund contribution. That's the difference between saving and falling behind. And there's one more layer almost nobody discusses. Credit card debt in America has crossed $1.13 trillion at an average interest rate above 21%. The personal savings rate is just 3.5%. 59% of Americans are uncomfortable with their emergency savings. This oil shock is landing on a consumer already stretched to the breaking point. There is no cushion left. When gas goes up $1, it comes directly out of grocery spending or clothing or the minimum payment on the credit card. And when that minimum payment gets missed, 21% interest starts compounding against you. Now let me explain why Trump's reassuring words today actually make the trap worse, not better. When oil crashed from $120 to $88 on Trump's comments, institutional investors who had been buying safe haven assets started selling. Gold dropped, energy stocks pulled back. The defensive positioning that was protecting portfolios began to unwind. Retail investors saw the crash in oil and felt reassured. Some probably sold their gold. Some went back to buying tech stocks. Some stopped thinking about protection entirely. But the war hasn't ended. Hegseth said it continues until total defeat. Iran says it can fight for 6 months. Ships are not moving through the strait except Iranian and Chinese-flagged vessels. Kuwait is still in force majeure. Iraq is still cutting 1.5 million barrels per day. Saudi Aramco's CEO is still warning of catastrophic consequences. The IRGC is still attacking tankers. 200 crew members are stranded on damaged vessels. 7 U.S. service members have been killed. And analysts have been explicit. Even if the war ended today, it would take 2 weeks to restore maritime traffic and 2 months to return oil production to normal levels. 2 months. That means elevated energy prices through April and May at minimum, higher gas prices through Memorial Day, higher grocery prices through the summer. The inflationary damage is already locked in for the next quarter, even in the most optimistic scenario. Bob McNally of Rapidan Energy Group said it best today. Traders assumed for decades that no country would be allowed to shut the Strait of Hormuz. The fact that it has happened at all is completely calamitous and unexpected. The thing that wasn't supposed to happen has happened, and a phone call doesn't undo it. So what do you actually do? The trap has 2 jaws. If oil stays high, you get crushed by direct energy costs. If oil crashes on temporary optimism, you get lulled into complacency while the secondary effects, the grocery inflation, the shipping costs, the insurance premiums, the production cuts, continue grinding through the economy for months. Here's the playbook that works regardless of which direction oil goes tomorrow. First, do not mistake a price drop for a resolution. Oil falling from $120 to $88 is not the same as oil returning to $65, which is where Goldman Sachs says fair value is without the war premium. Even at $88, oil is 35% above where the EIA projected it would average for 2026. Andy Lipo of Lipo Oil Associates said today it was too early to draw concrete conclusions from Trump's comments. McNally called the price drop verbal intervention. Comparing it to central bank job owning, words moved the price. Reality hasn't changed. Build your household budget for $80 to $100 oil for the next 3 to 6 months. Plan for gas at $3.50. If it comes in lower, that's money you pocket. If it comes in higher, you're prepared. Second, lock in your defensive positions now during the temporary pullback. Gold dropped from $3,400 to around $3,100 today as risk appetite briefly returned. This is exactly the pattern that creates generational buying opportunities. Every military conflict in the last 50 years has produced a gold pullback during moments of false optimism. And every single time, gold went on to make new highs as the reality of the conflict's duration became clear. The 1973 embargo, the 1979 revolution, the Gulf War, Iraq, Ukraine, the pattern is ironclad. Physical metal, GLD, IAU, mining stocks, precious metals, IRAs, 5 to 15% of your portfolio. The pullback is a gift wrapped in false optimism. Third, keep your energy exposure and consider adding on weakness. When oil whipsaws between $80 and $120 in a single day, the companies that produce it are wildly profitable across that entire range. Exxon's break-even is around $40 per barrel. At $80, they're printing money. At $100, they're drowning in cash. The quarterly earnings reports coming in April will reflect this entire period of elevated prices. Earnings revisions will be massive. Dividend increases are likely. Buyback acceleration is probable. These stocks may have pulled back today, but their fundamentals just got a multi-billion-dollar boost from 2 weeks of $80 to $120 crude. Fourth, keep building cash. High-yield accounts paying 5%, risk-free, instantly accessible. Warren Buffett has $373 billion in these instruments. His successor, Greg Abel, just started buying Berkshire stock during this crisis, the first buyback in nearly 2 years. Cash is not a passive position. It is the most powerful position in a volatile market because it gives you the ability to act when everyone else is paralyzed. Today's oil crash created buying opportunities in energy, gold, defense, and quality dividend stocks. The person with cash could act. The person fully invested in an S&P 500 index fund that's negative for the year had no ammunition. Fifth, build a 90-day financial buffer. 3 months of expenses in a liquid, high-yield account. This is not optional anymore. It's essential. When gas goes from $2.80 to $3.50 in 2 weeks, and the Fed can't help, the only safety net is the one you build yourself. Cut the subscriptions you don't use. Defer purchases that can wait. Consolidate trips. Carpool. Every dollar saved on discretionary spending is a dollar protecting you from the oil shock that hasn't finished working through the economy. Sixth, watch the data calendar like your financial life depends on it, because right now it does. Tomorrow, March 11th, the February CPI drops at 8:30 a.m. Eastern. Consensus expects 2.4% headline, unchanged from January. But the oil shock that started in late February will have begun flowing into the data. If CPI comes in above expectations, the last hope for Fed rate cuts in 2026 evaporates. The market sells off hard. Gold surges. The trap tightens. Friday, March 13th, the January PCE drops. Core PCE expected at 3%, a full point above the Fed's 2% target. This is the number the Fed actually watches. If it surprises to the upside, it confirms the stagflation trap is real and inescapable. Either way, you need to be positioned before 8:30 tomorrow morning. Here's the truth. Nobody in Washington wants to say out loud, whether this war lasts 5 weeks or 6 months, the damage to the middle class is already baked in. Gas will be higher this summer than it was supposed to be. Groceries will cost more. Airline tickets will cost more. Shipping will take longer. And the Federal Reserve cannot cut rates to ease the pain because inflation is running above target and accelerating. Trump called the oil spike a very small price to pay for eliminating Iran's nuclear threat. But the people paying that price aren't billionaires or hedge fund managers. They're the truck driver whose diesel just hit $4.16, the single mother whose grocery bill jumped $30 in a week, the family that was finally going to refinance their mortgage before rates spiked again, the small business owner whose shipping costs just doubled. The price isn't small for them. The G7 energy ministers are meeting tomorrow to discuss a possible joint release of emergency oil reserves. Trump is reportedly considering easing sanctions on Russian oil. Energy Secretary Chris Wright said the period of elevated energy prices will be temporary, but will not be short. Even the administration is admitting this isn't a one-week event. The trap is set. Oil crashes on hopeful words. Middle-class Americans relax. But the inflation is already in the pipeline. The production cuts are already made. The shipping routes are already disrupted. The insurance premiums are already repriced. And the wage price spiral confirmed by 4.2% inflation expectations is already spinning. There's also a political dimension that makes this even more dangerous. This is a midterm election year. Trump's economic agenda was built on the promise of lower prices. He said, "We're bringing it down. Energy is down. Gasoline is down." That was the narrative 2 months ago when gas was at $2.81. Now gas is above $3.15 and heading higher. The affordability message just collided head-on with an oil shock of his own making. Time magazine reported today that despite administration assurances the war will end within weeks, the widening conflict and Iran's unwillingness to negotiate have forced traders to price in the possibility of a wider conflict. Oil hit $120. The Strait is still blocked. Ships are still anchored. Production is still being cut. And the White House had to scramble to announce insurance programs for tankers and discuss Russian oil sanction waivers, none of which are sufficient to replace the 20 million barrels per day that normally flow through the Strait. This creates the ugliest possible dynamic for the middle class. The administration needs to project confidence to keep markets from panicking. So Trump says reassuring things. Markets briefly rally. But the underlying reality hasn't changed. Shipping companies won't transit the Strait until it's genuinely safe. Insurance companies won't cover the ships. Production cuts are deepening. This is the K-shaped economy. And the oil shock just made the divergence dramatically wider. High-income households with equity portfolios, energy stocks, and gold holdings benefit from volatility. Their Exxon shares surge. Their gold appreciates. Their treasury bills pay 5%. They can absorb higher gas prices without changing their lifestyle. The middle and lower income households are on the lower arm. They don't own energy stocks. They don't have gold. Their savings are in accounts earning 0.4%. Every dollar increase in gas comes directly out of their grocery budget. Their wage growth, already outpaced by inflation for months, just got hit by another shock. And the Federal Reserve cannot cut rates to help them because inflation won't allow it. The rich get richer from the crisis. The middle class gets squeezed. That's the K. The people who understand this, who maintain defensive positions during the pullback, keep their gold and energy exposure, build cash reserves, and prepare their household budgets for 3 to 6 months of elevated costs, these are the people who come through the other side with their wealth intact. Everyone else is falling into the trap. Before this war started, 46% of Americans said the cost of living was the worst they'd ever seen. 86% were concerned about gas prices. 59% were uncomfortable with their emergency savings. Credit card delinquencies were at a decade high. 45% of Americans couldn't cover an unexpected $400 expense. This oil shock didn't land on a healthy consumer. It landed on a consumer that was already drowning. And the response from Washington is a phone call saying it'll be over soon, while the Pentagon says it won't end until total defeat. Iran says it can fight for 6 months. Saudi Aramco warns of catastrophic consequences. Ships refuse to enter the strait. And production cuts deepen by the day. The gap between the reassuring words and the operational reality has never been wider. And the middle class is standing directly in that gap. This is the trap. Not just an oil trap, an everything trap. Rising energy costs, sticky inflation, a frozen Fed, a war with no clear end date, contradictory signals from the commander-in-chief, and an economy that was already running on fumes before the first missile was launched. The question isn't whether oil will be at $80 or $100 next week. The question is whether you'll be on the upper arm of the K or the lower arm, whether you'll be among the positioned or the panicked, whether you'll understand the trap before it closes or after. If this video showed you the reality behind today's oil crash that nobody else is explaining, hit subscribe now because this situation is changing by the hour. Oil went from $120 to $84 in a single day. Tomorrow it could go anywhere, and we'll be here every day breaking down what it actually means for your money, your family, and your future. Share this with someone who saw the oil crash today and thought the crisis was over. Share it with someone who needs to understand that a presidential phone call doesn't reverse 2 weeks of supply disruption, months of production cuts, and a wage price spiral that just hit 4.2% expectations. Share it with someone who's about to make a financial decision based on false optimism that could cost them thousands. The Trump reversal in oil prices isn't a rescue, it's a trap, and the only defense is understanding why before it closes. I'll see you in the next one.